Real estate has built more millionaires than any other asset class, but one thing that I stay away from is real estate flipping. Let me explain. The way real estate flipping works, let's assume this home is on sale for $200,000. The way that flipping works is you're going to work to buy this property for $200,000. Then you might put in an additional $50,000 in renovations and upgrades to this property. You're all in at $250,000. And then you want to sell this property for $325,000, a $75,000 profit. But you also want to be out as fast as possible. The goal is to be done in 90 days in and out. When you've bought this property as an investor, I'm gonna buy this property for $200,000. My goal will now be to rent this property out for say $2,000 a month. My goal here, if I bought this property all cash, will be to take the $24,000 I'm making a year, $2,000 a month times 12, $24,000 a year, and only spend about $10,000 a year in expenses. That will be $14,000 a year in profit. That's coming in year after year after year without me having to do anything, because it would be a more passive investment, because I would hand over the keys to a property manager. And then my goal will be to hold on to this for as long as possible. Maybe I could sell it in a few years, but at the very least holding it for at least a year. But really the goal is to buy it and hold it. That way you can make cash flow month after month after month, year after year after year. Now you're gonna say, well, Jaspreet, that's a lot of money you're saying no to. Well, you also got to understand that flipping comes with a different set of risks than when it comes to investing. Because when it comes to flipping, the goal is to sell it as soon as possible. When it comes to investing, the goal is to buy and hold. Of course, you can sell an investment at some point if you find a good opportunity or a good reason to sell, but the goal is to buy and hold. Here, the goal is to buy and sell as fast as possible. What are those reasons? Well, there's 4 of them. Number 1 is the time invested in order to do the deal. Number 2 is taxes. Number 3 is the income cap. I'll explain what that means. And number 4 is the risk that's involved. Starting with the time. If I wanted to go out and invest in a rental property now, I'd go out to find the property, do the research to find the property. After I purchase the property and do the renovations, I hand over the keys to a property manager who then does all the work. I don't know who the tenant is. The tenant doesn't know who I am. When the toilet breaks, they call the property manager, not me. I get a monthly report and a quarterly report and an annual report showing what's happening with the property, how much money we made, what the expenses are, and I just oversee what the management company does. So once the property is acquired, it's pretty passive on my end. I mean, yeah, I spend a little bit of time every month just reviewing the reports, but I'm not doing any active work. If I was flipping a property, there's a lot of time involved, because now I buy the property, and now immediately got to get the architects involved, got to get the contracts involved to do the renovations. Now, I renovate a lot of properties when I do a rental as well, but now when it comes to a flip, time is really important, because every day that you're sitting on the property, you are losing money. Now, it's the same thing with rentals, but now you also got to sell the property as soon as possible. So you're constantly working to make the best upgrades, to get the property up and running, to flip it as fast as possible. So you're much more actively involved as a flipper versus as a real estate investor. You're more passively involved, which also then ties into number 2, your taxes. As an attorney who's not your attorney, what I can tell you is that our tax code charges you differently when you make money actively versus passively, especially in the real estate space. So if you go out and you flip a property, you make $100,000, you're going to be taxed at ordinary income tax rates. It'd be the same taxes you pay if you made the $100,000 from a job. But if you earn that money as a real estate investor, because you're getting the rental income, you're taxed a little bit differently. You qualify for different tax deductions. You also qualify for different tax write-offs. This is one of the reasons why real estate investors love investing in real estate, is because of these tax deductions. Because as a real estate investor, when I go out and I buy a property, I get a lot of deductions. For example, I get a deduction which says my property is 1 year older, so I deserve a write-off. You don't get that when you go out and try to flip a property. This is called depreciation deduction. You get to write off the value of the property even if the home price is going up. I still get to take that deduction, which means I can make money every single year and pay little to no money in taxes legally, because the tax law says so. If you're flipping the properties, well, you got to pay taxes, because that's the way that it works over there. Number 3 is the income cap. I can make a lot of money today if I go out and I flip a property. But once that deal is done, it's no longer in my hands. If I buy a property for $200,000 and I flip it for $350,000, I might be able to make a big chunk of profit today. But if in 5 years that property goes up to $1 million, I don't get to get any of those gains because I've sold. When I buy a rental property, well, that property might grow in value. And I get to realize that if I wanted to sell it in the future, or I could pull cash out with debt if I wanted to, or you also get to see rental prices rise. So as the value of my real estate goes up, my rental rates generally go up as well, which means I get to make more money and I get to choose when I want to sell because I'm not under that pressure to sell when I flip. Because when you flip, you gotta sell and it's a one-time transaction. You do something, you flip it, you get the money, and then you walk away. Here, I make money every single month. And if the property values goes up, there's a lot of ways for me to take that money out or just keep it there because you're not capped on the income. And fourth also is risk. I started investing in real estate back in 2011 after the 2008 crash. And obviously that was a horrible time for flippers because what a lot of flippers were doing was when home prices were going up very quickly between 2000 and 2007, 2008, people were taking on a lot of debt, doing a lot of flips, and trying to just hold properties and flip them for quick profits. But then when things started to turn south, you lost all those opportunities because the home prices started to fall. And so you really are at risk of the economy, you're at risk of home prices, you're at risk of interest rates. There's a lot of things that can impact now your flipping game because you're constantly hoping the home prices are going to keep going up and that you can keep selling properties for a big profit. When I invest in real estate, I don't care where home prices are going. I buy properties with margin in them. That way, if the economy goes down, I can cut my rents and still be profitable. That's the way that I do my deals. If home prices go down, oh well, I'm still getting my rent. If home prices go up, great, that's icing on the cake. When I do all of my real estate transactions, I don't do the deals guessing or predicting where home prices are going to go. That's irrelevant to me. To me, what I'm looking at is cash flow. How much money am I going to make every single month? That way then I can work to just stack the cash flow. Now, the real estate flipping business is a business. It's an active business. I have a different active business. I run Briefs Media. That is my active business. So yeah, you could use that active business to fund more passive investments. For me, that's just not the game that I wanted to play. For me, I rather work to build Briefs Media. You might have heard me talk about things like Market Briefs. Market Briefs is one of the products that we publish. It's a free financial newsletter where my team is breaking down what's happening in things like the housing market, the stock market, crypto, the global economy, and our own economy. It's a fun, witty, and easy to read newsletter. You can read it in less than 5 minutes every morning, and it's completely free. So if you haven't joined Market Briefs, I got the link for you down in the description below. But that's where my time, energy, and focus are going because I work as the CEO of Briefs Media. That's my full-time job. And so I work to grow that business. As we make money, then I could use some of that money to go out and buy real estate. Some people do flipping as their full-time business, which is fine. That's what you want to do. It comes with risk. It comes with its own set of headaches. It's not something that I want to do. And you can take that money, and I highly recommend if you are doing that and you are making big profits, great. But then take that money and use some of it to buy some long-term rental properties because that's going to build you long-term wealth because that flipping is just an income. If you stop flipping, you stop getting paid, but you still got expenses to pay. You still got to pay for your house, you still got to pay for your car, you still got to pay for your groceries, you still got to pay for your vacations. And if you're not flipping properties, you stop getting paid, which is why you want to have these assets that continue to pay you. And the nice thing about rental properties is you can work to stack them because there's no limit to how many properties you can own. I mean, if you own one property and it's paying you $400 a month in profit. If you buy another one next year, that's an additional $400 a month. If you buy a third in year 3, that's an additional $400 a month. And if you do one a year, well, in 5 years, you'll have $2,000 a month in profit coming in from your rental properties. But it starts with one. And if you keep working to stack, you can just keep working to stack the cash flow. That's the way that I look at it. It's the opportunity to stack the cash flow, build income, pay less money in taxes legally, and also own assets, a hard asset, something that you can see, feel, and touch. And you can make it relatively passive. Now, of course, I got to say this. It isn't easy to start. When I started in real estate investing, it was hard. I screwed up so many times. I hired a horrible property manager that screwed me over. I hired a horrible contractor that screwed me over. I hired a horrible attorney that ripped me off. I mean, I went through a lot of mistakes. And that initial hump is anything but passive as a real estate investor. But if you can get past that, if you can get past that bad deal that you're going to have, every real estate investor has at least one bad deal. I've had multiple, but you're going to have at least one bad deal. But once you get past that, you're going to learn how to avoid those bad deals. And once you can avoid those bad deals, now it's a whole lot easier. And you can breathe a whole lot easier because you also have the time under your belt, you have the experience under your belt, and then you have the ability to go out and keep stacking it. But when it comes to active real estate flipping, that is a game. It is an active game, and you're going to have to keep playing the game if you want to keep getting paid It is not a real investment. It is a job, it is a business, it can make you a lot of money, it comes with a lot of risk, but you gotta understand, if you wanna be an investor, investing means holding something and wanting to keep it because you want to make money from that thing and let it do its thing while you do something else. This active investment, which is a full-time job, which is flipping real estate, is a way for you to grow your income. Real estate investing is a way for you to grow your wealth. A simple and basic way to understand if a company that you're thinking about investing in is overvalued or undervalued is by comparing these numbers from one company to another within the same industry. So what I want to do for the purposes of this video is I'm going to compare McDonald's, I'm going to compare Chipotle, and I'm going to compare Yum Brands. So let's start with McDonald's.